Hi, everybody. It's Michael, of course. Why else would you be here unless you like the episode with Ganja, which we do on Wednesdays better, which is fine with me if you do. I love the guy. I'm very close with him. So today I want to talk about how, a little bit of my evolution. I've talked about how I started because I think you're probably too hard on yourself. I know I was, but I also know that I just didn't quit. I was very persistent and determined. You have to find something that you're compatible with, that you can execute with. And in the beginning, you really want to focus on one thing, right? We talked about focus, I think, last week or the week before. And if you can focus on that one thing, at least that'll be your entrance ticket into the game, where it might not look sexy, but it'll be your admission ticket into the game where you can make some money and then refine it once you get there. I know a lot of folks want to see the plan all lined up, and this is how it's going to execute. And that really doesn't work in life. A lot of times you have to jump in and figure it out. Case in point, if you're going to get married and have kids, there's never a perfect time to start a family because you don't know shit and you don't know anything about parenthood. You might have observed other people, including your parents and their version of parenthood, but you don't know anything and can anticipate what's going to happen with you when it's your turn to start being a mother or a father. Right? Same thing with trading. You're going to figure out step number 2 once you get there. People are petrified of that, and that's what keeps a lot of potentially really talented people on the sidelines. Is they're so used to okay, I'm starting the semester, I'm going to get to know the teacher, I'm going to get to know the TAs, we're going to make friends, I'm going to do all the stuff, I'm going to make sure they know who I am, I'm going to get super clear on what the assignments are, I'll write my first drafts, then I'll redo them, maybe I'll get some feedback on the first draft, where are the holes, and so you know the game. Trading world isn't like that. It's just you against the market. Most of the time, internally, it's you against yourself. But in terms of trading and making P&L, you need a contra broker and another person on the side of the trade who obviously thinks very differently from you, right? So, you have to think about what that one strategy is. The good news is once you're willing to feel the feelings of the uncertainty, not just of the outcome of the trade, but of the outcome of the process, by risking real capital and figuring out hey, I got to fund an account, I got to get in, right? And there's a big difference between having one of these paper trading funded accounts versus trading your own money. I'm a big fan of the latter. The other one, yeah, it might help you raise some money if you're flat broke and you don't mind paying the $40 a month or whatever it is. But when I see people trading real capital versus people who are paper trading, their energy is completely different. The level of confidence goes up by a magnitude of 20. We'll talk about that another time. But again, you have to do what you can do, and you have to be, you have to figure out how much rejection did you want to face. A lot of people know folks who have money that they could go solicit, but they're unwilling to feel those feelings, right? And so that's the barrier to entry, right? The feelings that they want to feel are on the other side of asking people for money, which they don't want to feel. So I'll buy my way out of it by going to one of these funding outfits, and then I'll get into a coping mechanism, right? And then they'll justify it by saying, well, Mike, I don't have any money. Well, change that. And don't ask me how. Figure it out. I had to figure it out. Figure it out. It's on you. So over time, you develop like the guys in Market Wizards who trade fantastically differently than they did in yesteryear. They have to evolve, and by observing the market every day for 30-something years, in some cases, like in Victor's case, it's almost 60 years, you can learn to anticipate you develop a feel, right, from having put on real money, not paper trading and not these funding accounts, but running real money. You develop a relationship with the markets. You kind of understand how things go. It doesn't mean predictions any easier, but you can absolutely develop a feel for a market or several of them. A market isn't just the S&P. Sugar is a market. Microsoft is a market. So you can develop a feel. That's absolutely true, but it takes time. Yeah, sure, some people are kind of gifted, or they come to the table with skill sets that are inherently part of their personality. I'm one of them. I had really good insight and I had really good intuition, but it hadn't been calibrated with the market. But I really understood why people did what they did was because of feelings and emotions. I knew that when I was 14 years old, that people were motivated as pleasure seekers, and I was able to see that in everyone's behavior, whether they were my peer group or their parents. You see? Now, I didn't judge those people either, because who am I to judge somebody? I didn't walk a mile in their shoes. We're all products of our environment, right? So you can't judge people, but you can anticipate what's their nature, how are they typically going to behave, right? So likewise, when you start looking as traders or investors, you can kind of understand what are they likely to do, right? How are they going to behave? And over time, you can develop a feel. I developed a feel. I also don't like to fail, right? So I like to go back and challenge myself and see, can I overcome some of the things that I didn't do very, very well and showed basically no skill in when I was younger, like foreign exchange, like options and stuff like that. Just as a personal test. Sometimes I'll still fail, right? But the idea is that I get to challenge myself to see what I'm made of, right? You can do the same thing. I like to do that because even if I can't make money, I still get to learn a lot about myself, and having that skill of not necessarily being fearless, but being able to act despite the uncertainty of the situation. It only helps me hone that muscle, because what happens in trading? Everything is probabilistic. There's no guaranteed outcomes. But if I keep applying myself to learn new things where I don't know, like Anthony Bourdain, we talked about that. He started jiu-jitsu and I think he was 58, 59 years old. That's very late in the game, right? The kids that we sponsor from Brazil, they're on the mats at the age of 6. Iago's ranked number 1. He's been doing it for 5 years. Fabio he's been doing it for 11 years. And they're like 4th degree black belts, not black belts, they're 4th degree blue belts. And they're waiting to turn 18 to get their purple. Belts don't mean anything in that part of the world because they train 8 hours a day in a tournament-style school. They're basically black belts ability-wise, but because of the age requirements, they are where they are, right? So all of that doesn't really matter. Where you do get the skill is being on the mats. Where you get the skill is being involved in the markets and risking real money, right? A lot of folks that write me, I have a sense, are afraid to engage because they don't want to face the reality that they might lose money. So losing of the money is kind of incidental, just like having a runny nose is a symptom of having a cold. You can blow your nose all day. You might relieve the symptom. It's not getting rid of the cold. If you don't engage and don't put real money to work, you might be hiding around pride or ego. If I just study a little bit more, I can ensure that I won't have to feel those feelings. I got news for you, that's not going to be the case. So you might as well jump in and learn to fail fast. Those old kind of adages from, Silicon Valley, fail fast, fail forward, pick yourself up, know what you're willing to lose and get into the game, because that's where the education starts. Many of my black belt friends say that getting the black belt is actually the beginning of the journey in jiu-jitsu, not at white belt. So I had to evolve and learn new skills, part of it as a personal challenge, because I wanted to have a more well-rounded education. The beautiful thing that I figured out, which I didn't know at the time, is that there is a relationship between the underlying security and the derivative. And by looking at a different asset class, you can kind of understand your first asset class a little bit better, because now you have a little bit of compare and contrast. I didn't know that ahead of time. It seems obvious probably to many of you now, but back in the day, there wasn't that type of wisdom floating around. So again, being self-taught, that's kind of the benefit. You come up and figure out a lot of these gems, and they kind of hit you, and you're like, oh, okay, I have a better understanding of how the underlying trades by watching the options. Then there's other trades where they look close to your setup, but they're not quite there. And you can still kind of see, well, I didn't get involved in certain trades, and they were close to where I was going to get in, this and that, but they didn't behave correctly. And then all of a sudden, there's a big blow-off, and the market sells off. And then you learn, and it reinforces why you want to have discipline and not jump the gun, right? Same way you kind of learn the hard way that if an instrument's trading in a certain range, it doesn't always pay to buy when it's at support and then sell it at resistance, right? So you learn these things oftentimes the hard way, but they help harden your soul a little bit so that you don't become your own worst enemy, and you continue to remove the mistakes that you make, because those mistakes or those lapses in discipline tend to cost you money on your P&L. I'm going to talk a little bit more about that. Actually, we're going to talk a lot about that on Thursday. So Two, I don't think you need to label yourself. There seemed to be some feedback about my, pivoting and adopting my ability to overlay better with the current market environment. That's just Darwin, right? That's Darwin. You should all have that ability. And if you don't have that, it'll become more apparent on Thursday, because tomorrow we'll have ganja, of why you want to do that. Two, you might be married to something in your ego, like where you have to label yourself as a day trader or a swing trader. All those names are kind of bullshit. They don't mean anything. But if you need that because of your identity with yourself, or because you think it might impress other people, no one cares. Because unless you're dealing with the trading community, most lay people don't even know the difference between what the different strategies are. It's over there. It's not their paradigm. So, be true to yourself and be honest, even if you don't have to be public. You don't have to share stuff if it makes you feel insecure. Two, you have to understand that, there's a difference. You can have a split personality on some level after a significant amount of time has transpired, and you know who you are and behaviorally, and how you integrate that behavior with the marketplace. So, for example, outwardly speaking, you might be an investment advisor who does buy and hold for 6 to 12 months, but in your own personal money, you might be a swing trader. Is that being inauthentic? I don't think so. I think it's fine to be Jekyll and Hyde, right? Because what you look in the criteria of your own money is your personal business. It's not for anyone else to judge. And so when you think about the business and how you get paid, there are strategies that you might handle for your own money, but then there might be other strategies that you handle for other people, right? And both are legit, because you have to meet the needs of the client. There are some potential conflicts if you're buying and selling securities for your own account on the same day that you're doing it with the client, right? And you're at, say, a wirehouse. You typically have to give them the better prices. That's a wirehouse compliance issue. If you're an individual trader, though, and you're handling money for individuals and you're handling your own money, then you have to serve all those clients. You have to meet your own needs emotionally and financially. Then you have to meet your client needs emotionally and financially. And you might be able to affect two very, very different strategies. You might be a swing trader in your own account, and you might be an options trader for your clients. Nothing wrong with that. There's no rule that's written that says you have to be one thing like the folks in Market Wizards, which is why I brought that up on whatever that was yesterday, and be that for 50 years. It doesn't work that way. Those models evolve. The people evolve, right? Now, if you're puritanical and you have judgment and what you think, then, my whole thing on the judgment is flake off. You're in no position to tell me how to behave. I get to write those rules. You see? To me, it's clear blue sky. Two, when you handle client funds, which many of you probably don't do, you have to take into account compensation. In many of the instances in the professional world, there isn't a dead money fee. If you're an investment advisor, yes, and you work at a wirehouse like a Merrill Lynch or a Morgan Stanley, you charge an asset management fee per annum. You get paid quarterly in advance. You have to split that with the house. If you are outside of that environment, which wouldn't allow you to have incentive fees, right, you are earning a portion of the profits. So it's an amateur take on things when you come in and say you're abandoning your main strategy. To me, it shows a lack of connection to the market and inexperience on how markets work. So when someone says, if you don't make money, you don't get paid, it's because that's the compensation agreement that the person has with that particular client. So you have to adapt and adopt to make money for the client and do what's right for them. And if you do what's right for them, there'll be a nickel in it for you. So again, here, the show is not to pick on people or to tell them that when they're stupid and they don't know what they're talking about. It's to edify you on the greater situation in the marketplace so that you realize how much opportunity there is for you, right? Because I don't care how you trade. I have never told day traders to flake off and not be part of the show here. I'm happy to give back to the community and help any way that I can. So I will, continue to do what I think I need to do to serve my clients. We're all on the same page. Everyone knows what the rules are, right? And then I'll get compensated accordingly. Of course, the main goal in any of this is keep your losses small. You can come to the market and want to be hell-bent for election and crush the markets and make a lot of money. But, when you hear marketers say things like get above average returns, you have to understand that with that comes above average risk. There's a correlation there. You don't get to say you can't steal second without taking your foot off first base. So let's get above average returns. Sure, you can find trading systems and this and that might work. But like I mentioned with the turtle rules, you open yourself up to having drawdowns that are greater than the S&P 500, and then also the other comparative benchmark indices that an allocator would look at and say, is he or she outperforming the markets in their benchmark returns? And they look at that from two different standpoints. It comes down to risk-adjusted returns. If you have manager A who does 50% a year, but also has 35% drawdowns, and then you have manager B who does 20% rate of return with only a 2% drawdown, which is better if you're an allocator? Which is better for your money? It's not necessarily a trick question, but there is no right answer. In the first scenario, you have you don't have a 2-to-1 ratio, right? Because with a 35% drawdown, that's more than half of the upside, right? Which is 50%. So you have to figure, what can you live through? The other manager has a 10-to-1 ratio, and they do exist, right? You just have to look hard. A lot of times they don't want to have to deal with the bullshit of registration and having to deal with other people, right? So they just do their own thing. So then the question is, are you better off with a manager who makes 20% steady Eddie, and only does 2% drawdown and is able to retain the majority of those gains? So from an allocation standpoint, you have to think about risk-adjusted returns, which is kind of what they do. I'll take it a step further, then I'll call it a day because we're coming up to another longer episode here. Allocators don't necessarily care if you have $20, $30 million under management. That used to be the case. When I started, they typically wanted to see you have 10, 20, probably 20 million in assets and a 2-year track record. The rules have changed quite a bit. We talked about that yesterday, and now they're a little bit, I don't want to say forgiving, but if you can show that you can create alpha with smaller pools of your capital, not funding accounts stuff, real money. What's the number? I don't know, 50, 100K, something like that. And you can create alpha consistently with that. There are outfits that will give you a shot with real money without the handcuffs that you get with these funding accounts. So yeah, you save the $40, but you actually get to be you. You don't have to kind of conform your behavior to other people's risk management rules, right? Which is a big problem with those funding accounts. We'll talk more about that maybe Friday. But anyway, I appreciate you being here. We're coming up on 19 minutes, a little longer than normal. A lot to say, though. I told you we had a lot to catch up on. Be here tomorrow with Ganja. If you're still listening and you're still watching, thanks for being here. Don't forget, if you go to Martin Chronicle, you can get a free copy of the audiobook version of The Inner Voice of Trading for free. That's where we kind of communicate mostly. And if you wouldn't mind or you find anything about the show that's good, please leave a comment, like, and subscribe. I'll see you tomorrow with Ganja. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.